Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ATLASSIAN Corp. Quarterly Report. ATLASSIAN Corporation offers a diverse range of collaboration software solutions that cater to various business needs. At the core of its product portfolio are Jira and Confluence, which enable organizations to manage projects and share knowledge effectively. The company also provides specialized tools such as Loom for asynchronous video communication, Jira Service Management for IT and HR teams, and Rovo's AI capabilities. In addition to these offerings, ATLASSIAN provides Bitbucket for source code management, Compass for developer portals, and Jira Product Discovery for product ideation. Its enterprise agility solution, Jira Align, connects business and technology teams to align strategy with execution. The company also offers Focus as a strategy hub for leadership teams and talent for workforce planning. Furthermore, ATLASSIAN provides Trello for personal productivity and Guard for security threat detection. These diverse solutions demonstrate the company's commitment to providing innovative tools that cater to various aspects of business operations. ATLASSIAN Corp's stock price has experienced a significant decline of approximately 69.86% over the past year, from $326 in February 2025 to lows around $92-$105 in early February 2026. This crash was primarily driven by a confluence of broader market trends and specific company-related news events. One key factor contributing to the stock price crash is the SaaS-spocalypse, a downturn in the software-as-a-service (SaaS) sector, fueled by concerns over the potential impact of artificial intelligence on traditional SaaS providers. Growing apprehension among investors regarding AI disruption also played a significant role, particularly with the introduction of powerful AI agents that could automate tasks traditionally handled by ATLASSIAN's project and task management software. ATLASSIAN's quarterly earnings reports have also been a source of concern for investors. The company reported its slowest revenue growth in years, 14% year-over-year, for the fiscal third quarter ending March 31, 2025, despite exceeding adjusted earnings and revenue expectations. Additionally, concerns over free cash flow and perceived underwhelming growth in billings have contributed to investor unease. The stock experienced a significant drop even when ATLASSIAN's revenue and adjusted EPS exceeded expectations due to ongoing fears about AI disruption and a broader software sector sell-off. The CD downgrade and price target reduction in January 2026 further added to the decline, citing pessimism on underlying cadence and quality of top-line growth. The Pomerantz law firm investigation into potential securities, fraud, or unlawful business practices also contributed to investor uncertainty. The combination of these factors created a challenging environment for ATLASSIAN's stock, leading to the substantial price depreciation over the past year. The primary drivers of revenue growth or decline are multifaceted and influenced by various internal and external factors. On the positive side, revenue growth is driven by key adoption within organizations, successful price increases, effective product support, strong relationships with solution partners, efficient collection of accounts receivable, and successful marketing and sales efforts by these partners. Conversely, revenue decline can be attributed to several factors, including loss of key personnel, difficulty in hiring and retaining skilled professionals, fluctuations in stock price affecting employee retention, catastrophic events such as natural disasters or pandemics, and the long-term impact of climate change on the global economy and technology industry. Additionally, other factors that can impact revenue growth or decline include changes in laws and regulations affecting the technology industry, compliance costs and burdens imposed by industry-specific laws and regulations, export control and economic sanctions laws, anti-corruption laws and regulations, and government regulation or increased regulatory scrutiny due to evolving business models and emerging technologies. The net income of a company underwent significant fluctuations between 2024 and 2026. Initially, it increased by $4.1 million in 2024 compared to the previous year. However, this trend reversed in the 6 months ended December 31, 2025, with a decrease of $102.2 million due to changes in earnings and losses from foreign jurisdictions and the partial release of valuation allowance on U.S. deferred tax assets. Despite this decline, net income rebounded in 2025, increasing by 134% from $255,627 to $596,538 compared to 2024. However, it decreased by 23% in 2026, dropping to $455,327. The fluctuations in net income can be attributed to various factors, including changes in earnings and losses from foreign jurisdictions. On the other hand, profit margins showed a consistent upward trend. Gross margin increased from 83% to 85% between 2024 and 2025, and further rose to 88% for the 3 months ended December 31, 2025. Operating margin also improved during this period, increasing from 24% to 27%. These increases in profit margins indicate that the company was able to maintain its pricing power and control costs effectively. The company is indeed generating positive operating cash flow. This is evident from the financial statements for both the 3 months and 6 months ended December 31, 2025. The net cash provided by operating activities was $177,805 for the 3-month period and $306,519 for the 6-month period, indicating a steady increase in cash inflows. These positive results are further confirmed on page 44 and page 54 of the financial statements, reiterating the company's ability to generate sufficient cash from its operations. This is a significant indicator of the company's financial health and stability, as it suggests that the business is capable of covering its expenses and investing in growth initiatives without relying on external funding. The company's financial situation has undergone significant changes in recent periods. One notable trend is the substantial increase in interest expenses. In the 3 months ending December 31, 2025, interest expense rose by $5.2 million, 72%, primarily due to the amortization of interest rate swap contracts. This surge was also observed from 2024 to 2025, with a 45% increase in interest expense. The company's debt level has also seen a substantial rise, increasing by $1 billion following new debt issuances. As a result, higher interest rates on these new debts have contributed to the increased interest expenses. Conversely, interest income decreased by $7.5 billion, 29%, during the same period, indicating that the company is bearing more of the financial burden. These changes suggest that the company's debt level and interest expenses have indeed undergone significant shifts in recent periods. The performance of various regions and segments in the company's financials has been mixed. On a positive note, the Americas and Europe have shown significant growth, with revenue increases of $132,000 and $120,000, respectively, in Q3 2025 compared to Q3 2024. In contrast, several regions have underperformed. The United States saw a substantial decline in revenue by $39,013,000 from June 30, 2025 to 2025. Similarly, Australia's revenue decreased by $3,259,000, and India's revenue dropped by $4,813,000 during the same period. Additionally, all other countries experienced a decline of $2,733,000 in revenue. On a more encouraging note, the deferred contract acquisition costs segment has performed well, with an increase in balance by $71,038,000 and additions by $19,824,000. Management is optimistic about the company's outlook, citing its focus on cloud-based solutions and customer migrations as key drivers of growth. The company plans to continue expanding through acquisitions and strategic relationships, while also enhancing and expanding its platform with AI technology. However, management acknowledges various risks and challenges that could impact the company's performance, including regulatory scrutiny, intellectual property rights, litigation, and volatility in stock price. Management is aware of the importance of environmental, social, and governance (ESG) best practices and reporting standards, but also faces risks related to failure to meet these standards. The company's ability to service its debt depends on future financial performance, which will be affected by economic conditions. Management recognizes that revenue may fluctuate due to seasonality, particularly in the second and fourth quarters, and that the company may require additional capital to support operations and growth. Overall, management is committed to maintaining corporate values while navigating these risks and challenges. The company's strategy is centered on leveraging cloud-based solutions and AI technology to drive growth, while also prioritizing ESG best practices and reporting standards. The company's financial strategy has been focused on returning value to its shareholders. One key aspect of this approach is the implementation of 2 share repurchase programs, which have enabled the company to buy back shares from the market. This move aims to increase shareholder wealth by reducing the number of outstanding shares and thereby increasing each remaining share's value. However, despite these efforts to return value to shareholders through share buybacks, the company has stated that it does not intend to declare dividends in the near future. This decision suggests that the company is prioritizing other uses for its profits, such as investing in growth initiatives or paying down debt. That concludes the financial summary for Atlassian Corporation. Feel free to comment below, and I will be happy to answer them when possible.